Hey everyone, my name's Andy. I'm from the Finding Value Finance channel. I've got Nick with me. I'll show you real quick here. This is his Twitter. It's AllThingsVentured. Trade, shipping, commodities. Obviously, none of this is supposed to be used as investment advice. But I wanted to get him on the channel. Wanted to get his opinion on shipping. Again, if you want to follow him, it's at AllVentured. So let me go here, stop share. So Nick, I've got you on the channel. Welcome to the channel. Thank you for coming on. Really appreciate it.
Yeah, thanks for having me.
So just to kind of warm things up, can you tell us a little bit about your background, kind of what got you interested in shipping, if you have any experience in shipping, stuff like that?
Sure, yeah. So, I started trading probably 2007. And, during that time, it was actually funny. The stuff that was going up and to the right was shipping at that time. And we didn't have Wall Street bets and the madness that's going on now. But back then I was just kind of one of these kind of dumb kids coming into it and buying what was going up and to the right. And so kind of just stumbled on it, but have followed it ever since, and ended up having a career, 9 to 5, working in trade. Where ran an import company that was importing 4,000 containers worth of glass containers into the U.S. through the port of Oakland every year. Got probably more than 150 days in China working in trade. So got some interesting insights into the shipping business from that side, and eventually did well enough with my trading to make it my full-time job. So that's been doing that full-time for now, gosh, like 4 years. And I would consider my core competency to be shipping. And it's just a cool little niche sector to follow, because it's got these giant boom bust cycles where there's a lot of alpha to be had, because a lot of the information is available in advance on what the supply side is going to look like. And there's a lot of writing on the wall on what the demand side is going to look like. So if you're one of these people that likes to really do your own due diligence and dig into the supply and demand factors, you often can figure out and on a risk reward basis, figure out which direction these markets are going to go, or which way they're going to trend. So, really just fell in love with the shipping business, and it's been good to me.
So you said you're a full-time trader for the past
Yes.
however many years, 3-4 years. Just to ask, kind of pry into that just a little bit. Are you doing options? Are you just buying stock? Like, how are you playing the markets?
Sure. So my weapon of choice is the option, and I like the option just because it gives me a lot of flexibility as far as presetting my own entries and exits. It's hard in the moment sometimes when you want to express a thesis with just equity. That time comes where you should be selling and you don't sell, because you're caught up in the moment. And so I like options from that standpoint. It also, you can get some leverage, you can kind of do some things, play around with risk. But I would say that about more than half of my money is tied up in a longer term thesis, where I'm trying to hold stuff for many years for the cycle. And then I do a lot of trading around the edges with risk management and what I think is going to move in the short term. But a lot of my core shipping holdings are now well over a year, and I'm planning to hold them for the cycle, because I'm very bullish on especially dry bulk and tankers right now for really the next few years, and possibly even the rest of the decade. So
Okay, so you do have stock holdings, and then you play options on the edges in the short term. Is that
exactly?
Statement? Okay.
Exactly. Yes.
And so you said dry bulk shipping. Obviously, there's a investment cycles. There's cycles to this. Where are we in that cycle, and what does that cycle look like, or what do you expect from the cycle going forward, so to speak?
That's a great question. So, when you look back at shipping cycles and the dry bulk cycle, especially, we tend to go in these like big 10, 12-year cycles from absolute boom, where, these companies are just printing money, to bust, where half of the industry goes bankrupt. And then inside those cycles, we have a lot of mini cycles where, we get to some level of profitability, and then suddenly all of the shipping companies run in and they order ships, and a couple of years later, the ships all deliver and we go back towards break even or worse, right? So right now we are coming off of, I would say, the cycle, the longer 10, 12-year cycle probably bottomed 3-ish, 4-ish years ago. And at the very end of this just brutal down cycle in dry bulk shipping, we had two really bad black swans. One was the biggest, as far as shipping volume goes, the biggest shipping volume company is Vale, iron ore producer in Brazil. And they had this dam disaster where they lost a huge portion of their production in 2019 and just absolutely decimated the dry bulk industry right when it was starting to bottom. And then a year later, we get COVID and a second black swan right after that. And these valuations went just to absurdly low levels that didn't make any sense. And since then, we're coming off this bottom and we're kind of on the upswing. But even though we've now had a couple of years of extremely profitable shipping rates for dry bulk, nobody's ordering ships. So, these kind of mini cycles that I was telling you about where, even in the longer term cycle, as soon as you get profitable rates, the companies run out and they buy more ships, and a couple of years later, you have a bunch more ships deliver and rates go back down. This time is not happening. And it's almost amazing, but there's a lot of things that are contributing to no new supply coming on. One is ESG mandates. The International Maritime Organization, which is the lawmaking body for shipping, is trying to decarbonize shipping, which is really quite hard to do. And they put on some standards that come into effect January 1st of 2023 that are going to start to letter grade out how efficient each ship in the fleet is. And they're going to require to be compliant that most of the ships are going to have to slow down, which is going to shrink the size of the fleet. In addition to this, people don't know what the ship of the future is going to be. And because they don't know what to invest in, they're just not buying new ships. And so right now, despite 2 years of extremely profitable rates, the dry bulk order book is now sub 7%. And so to put that in perspective for everybody, that 7% is the shipyards are now full out through, especially for large ships, through mid 2025. So for the next 3 years, you've got 7% delivering, and ships only last. The typical dry bulk ship is out trading somewhere between 20 and 25 years. So just on a straight line basis, you have, somewhere between 2 to 4% of the fleet is aging out every year and needs to be replaced. But we've only ordered enough ships through middle of 2025 to replace ships at, what is that, a low 2% rate? And that doesn't accommodate trade growth, which typically, if you look back over time, trade growth grows with global GDP growth. So if global GDP is expected to grow at 3% a year, and you have dry bulk growth at 3% a year, less scrapping, you're at 9% expected trade growth over the next 3 years. Plus, you got to replace the maybe 6% of ships that are going to be scrapped. That's 15%. Yet we've only ordered ships to replace 7% of that, and rates were already high for the last 2 years. Mm-hmm. So today's supply side setup is totally unprecedented. And so that the whole investment thesis around dry bulk really centers around this whole unprecedented supply side setup, which is the same kind of lack of capital investment that we've seen across commodities, across energy. It's the same in shipping right now, except I would argue that for shipping, you actually have better visibility into the supply side than you do for things like oil and gas energy. Right now, if you want to go and drill a shale well, you can start drilling today. You can have that thing producing in 6 months. But we know for the new ship order book, the shipyards are full through the end of 2024 for the smaller sizes, and for the big sizes, they're full now through the middle of 2025. You have excellent visibility that there's no supply coming to the rescue before 2025. And so really the art in figuring out shipping is all on what you believe is going to happen on the demand side. And so, you know, a lot of people will ask, why are these stocks trading so cheap on a price earnings ratio basis? You know, like some companies out there, like a Navios Partners, you know, based on my models, they're trading at like 1.5 times forward earnings. Okay, it's crazy. And so, you know, the first impulse is you see a lot of these people say, never buy cyclicals at a low PE, right? You want to buy cyclicals when they're unprofitable and wait for the upswing. But you know, it might be different this time because we have an unprecedented low level of new supply coming on. So why are these prices so cheap? Why can you buy these dry bulk shipping companies at 1.5 times forward earnings? Well, dry bulk is especially economically sensitive, and there's a lot of concerns right now over the global economy. And dry bulk is also especially China based. I think something like 50% of the world's seaborne dry bulk trade is involved with China somehow. So, you know, 50% of the world's dry bulk trade is generally commodities going from all over the world into China. Mm-hmm. And so, you know, when we have this concerns over the property market sector, which is the big driver for steel demand in China, and the biggest traded commodity for dry bulk shipping is iron ore. And the second biggest commodity traded for dry bulk shipping is coal. And you have iron ore and coking coal, which are two of the ingredients that go into steel making for the biggest sector in China, which is the property market. People are concerned that property market implodes, dry bulk shipping demand implodes, these rates are unsustainable. And you know, even this year, some of the demand side has taken me by surprise. This has really kind of fallen off a cliff as far as the demand side for dry bulk shipping. But you know, the thing with China is that they have to support their economy, and we've seen in the past that they've come in and they've provided some stimulus to kickstart the property market again and to kickstart steel production. And you know, if we see that kick in again, the supply side hasn't gotten any better for the dry bulk shipping market. So, and it's really not going to get much better for the next 3 years. So if China is able to successfully stimulate their way out of this slowdown and end the COVID zero thing, it certainly looks to me like we are going to have some extremely high profitable dry bulk rates in the coming years.
Yeah, so I know there's a lot of renewables. I know there's a lot of electric vehicles and all these other things that people want to also move. Does that have any impact on dry bulk shipping? Because I know renewables are much more mineral intensive than oil, gas, and nuclear. They're also, electric vehicles are much more mineral intensive than internal combustion engines. Is there any sort of demand that could be increased from increased demand of renewable energy?
Totally. There's there's a major tailwind, especially in the smaller dry bulk sizes, for all of these minerals that are going to be needed for the energy transition. As far as the large ships goes, the largest ships, the Cape-size ships, they're carrying primarily three things. They're carrying iron ore, which is used to make steel. They're carrying coal, which this year we're going to go back to this. This will be the largest year on record of coal use in the world, and the IEA is actually forecasting that next year will be even more coal use. So there has been this narrative of peak coal, and that we're already past it, but we're finding out that coal and seaborne coal is a lot more sticky than we think. And when you look at the industry people think that coal use will continue to increase through at least 2025. The third largest commodity that's shipped on dry bulk ships is bauxite, which is used to make aluminum. Mm-hmm. And aluminum is going to be huge in the energy transition. When you're looking at EVs, and when you're looking at infrastructure for the grid, EVs are going to need a lot more aluminum because it's lightweight. And the grid, we're talking about copper is going to become so expensive that you're going to need to use more aluminum for transmission. And you look at what aluminum prices have been doing, they've just been going bonkers. So more aluminum, more steel needed for all of this infrastructure that's going to happen is going to be totally supportive of dry bulk shipping.
Okay, and so when you look at shipping in general, where do you see the most opportunities? And I'm just kind of talking in general. Is it like tankers, dry bulk, container? Like, where are your favorite sectors where you're like, I keep coming back to this sector or these two sectors? Where's the opportunity?
Yeah, so in the coming years, just from by far the best supply side setup is in tankers and dry bulk. I fortunately got in at the bottom of the container trade, and that has been incredible, but we're now more mid-cycle there, and the order book is a little bit scary, to be perfectly honest. I still own quite a few container lessors because the valuations are just kind of no-brainer cheap, but those aren't like multi-bagger type opportunities. I think that there are many names in the tanker and dry bulk space that have multi-bagger opportunities now because of just very, very little CapEx spending and very low order books. So, we talked a little bit about dry bulk, but tankers, something very interesting is happening right now in tankers. Trade patterns are shifting like crazy right now because of the sanctions that are being placed on Russia. So Russia is one of the world's top exporters of oil, and historically, most of oil and oil products have gone from Russia to neighboring Europe, which is very short haul. A lot of it does move by sea, but it's very short distance, and a lot of it moves by pipeline. And what we've seen with sanctions is instead of all of this oil moving from top exporter Russia to neighbor Europe, the only people in the world that will take Russian oil right now are India and China and other smaller countries that are pretty far away. And so all of that oil that used to ship short sea in smaller tankers is now going on the largest tankers all the way around the bottom of Africa and over to India and China. And Europe, which used to get all this oil from Russia, is now having to import its replacement oil from faraway places, the US Gulf, the Arabian Gulf, Brazil. And so just in the last 6 months, we've seen ton-mile demand for tankers go up by I think we're approaching, at this point, we're approaching double digits, plus 10% kind of thing versus where we were 6 months ago. So, there's a thread that I put together back in April, kind of analyzing what does this dislocation in the oil market mean for tankers? And when you look at the oil that's coming back on from OPEC raising its quotas and from the Russian supplies that are getting all diverted everywhere, I estimated that we probably need another 100 VLCCs into a fleet of only about 870 VLCCs, which are the largest tankers. So that's why you're seeing tanker rates right now are going parabolic. And unless there's some resolution with this Ukraine conflict, there's really no reason to believe that tanker rates are going to come back to lower levels. If anything, when the sanctions go into full effect early next year, and because currently Russia is still sending a lot of oil to Europe, and the full ban goes into effect February of next year. When that happens, tanker rates and tanker demand is potentially going to go parabolic. Meanwhile, same setup as we talked in for dry bulk, the tanker order book now is below 7% through 2025. And tankers have a pretty hard date at very, very rarely do tankers very rarely do tankers make it past 22 and a half years. So at 22 and a half years, they're generally scrapped. So right now we have much larger quantity of the tanker fleets that's over 20 years than the new tankers being delivered in the next 3 years. So we're looking at negative fleet growth for tankers despite unprecedented demand and unprecedentedly high rates. And so that's why you're seeing tanker rates and the tanker equities kind of going parabolic right now.
Yeah. All right. So what are your kind of companies and how would you play this bullish thesis on dry bulk and tankers? What are some of your top picks, and what are some companies that you might want to even stay away from, or in your opinion? So
sure. Great question. So, when you're looking at dry bulk and tankers, I can definitely recommend for people that are new to the space to stick to the kind of blue chip names in the space. So in dry bulk, the biggest dry bulk ship operator publicly listed in the US is Star Bulk Carriers. Fantastic governance, good dividend, buybacks, legit management that's aligned with their shareholders. Can't go wrong with Star Bulk Carriers. On the tanker side, the big blue chip is Frontline. They just actually are in the process of merging with the second biggest tanker company, or an equal peer, Euronav. That once that deal is done, this is going to be far and away the largest tanker company out there. Once again, great management, great company, great fleet. Can't go wrong with either of those ones. Personally, because this is my sector and this is what I do, I like to play in some of the smaller and more idiosyncratic names. My top pick in both dry bulk and tanker sector, because it's a mixed fleet, is Navios Partners, ticker NMM. And so they just recently concluded a final deal to roll up the rest of the dry bulk fleet from their former parent company, Navios Holdings, and now are the sole remaining Navios entity that owns ships. It's one of the cheapest names in the space because there have been management concerns. So I definitely recommend, viewers do your own due diligence on this. But the reason why I like it is far and away the cheapest thing out there that I'm looking at on a risk-adjusted basis. They just announced a $100 million share buyback. So all this speculation that they weren't going to be shareholder friendly, hopefully once we see that buyback used, we can put that one to bed, and the 70% discount that it trades at to its net asset value will prove to be completely unjustified. And in shipping, we like to talk a lot in terms of net asset value, which means if Navios Partners was to sell their whole fleet at market prices today, how many dollars per share would Navios Partners have in cash? So if Navios Partners was going and sell all those ships at market prices today, they would have over $100 per share in cash. These shares currently trade at $30 a share. So you can see that there's a huge disconnect, whereas the larger peers that have great managements and have a track record of good management, like your Star Bulk and your Frontline and Euronav that we talked about, those companies right now trade very close to full net asset value, dollar for dollar. On a risk reward basis, Navios Partners could be, or I'm expecting it to be, potentially a multi-bagger in the coming years. Not investment advice, but there's an opportunity there. The cheap name that I like in the tanker space also has some hair, so do your own due diligence, is Tsakos Energy Navigation, so ticker symbol TNP. Once again, one of these ones that has some management concerns. It's kind of family owned and operated. There's some related party dealings. Definitely do your due diligence, but also trades at 40% of NAV. So even if it were to go to 80% of NAV, it would have to double. And this is into a rising market. And so that's kind of the YOLO roll the dice kind of name in that sector. But if you're new to shipping, I would definitely say stick to the blue chip type names, Frontline, Nav, Star Bulk carriers. But my picks and where I'm kind of where my money's at is in some of these more idiosyncratic names. As far as the stay away from, you know, there's a number of companies out there that are still issuing shares. So, you know, I would be very careful with these companies that are still selling shares, because the shipping business is known to do this. You have, you know, these small companies out there, and, you know, the management is not necessarily aligned with shareholders. One of these companies that has issued a lot of shares, and maybe they've turned the corner, maybe they've not, is Castro Maritime, CTRM. Okay. You know, if you do believe that they've turned the corner and you believe that they're not going to issue any more shares, it's very cheap. And they have both dry bulk and tanker assets. But that's something that if you're going to play in that name, you need to monitor very carefully on if they're going to continue to issue shares. And I, you know, having been a long-term Navios Partners holder, you know, my money could have done better elsewhere rather than sitting through the period where they issued shares. So I would just, you know, be very careful of any shipping company that's currently issuing shares. You want to be in the shipping companies that are buying back shares now. Yep,
I agree. I like Castro though.
Yeah,
it's the chart though, especially.
It's very cheap. You know, I've gambled in it a few times, and you know, I haven't followed it super closely lately, but I do believe last I looked, they have said that they're not going to issue any more shares. Is that correct?
Fingers crossed.
Fingers crossed.
That's what they say.
Yeah.
And the chart looks good. So, and they're bringing in lots of cash now, but we'll see. I agree. We'll see.
Yep. And it, you know, it's all just a risk reward play. And Castro is one of those ones that I know that they trade at a very, very steep discount to net asset value. You know, yep. If I were to see them come out and announce a share buyback program, and actually use the share buyback program, you know, I think that that those shares would not revalue as quickly as they ought to. You know, that could be an incredible buying opportunity. So, you know, I like to keep tabs on everything in the space because things change, you know, and especially in a bull market where these companies that went from being forced to issue shares for liquidity problems because they were in a bear market to suddenly they're printing cash. What do you do with all the cash? And suddenly you take a company that was absolutely hated by the market, and suddenly they're buying back shares at a tiny fraction of net asset value, and these things can become rocket ships.
Yep. So
yeah, definitely do, you know, look around. There's a lot of opportunities out there.
Now I'm a natural gas guy. I love natural gas. And okay. I'll ask you the question, you know, LNG shipping and stuff like that. How do you view the liquefied natural gas market, and what is that market, the shipping market, telling us about natural gas itself? Do you see any discrepancies or opportunities in the shipping or of natural gas or natural gas in itself?
Sure. Yeah. So, you know, it's funny when, you know, this whole thing with the Ukraine situation developed, suddenly you had all these people coming in and asking about natural gas shipping. And so you had a lot of people that were new to shipping from that standpoint. And for the people that were on the front side of it, the LNG shipping equities have done very, very well. I would consider many of those to be more fully valued now. So, you know, I don't really have any position in the LNG gas shippers, but there is a compelling argument because, you know, this energy shortage, this global energy shortage that we're dealing with has really lit a fire under making a final investment decision on a lot of these LNG export projects. And when you look at the data, we have more LNG export capacity coming on sooner than anybody really anticipated. And so there's a lot of interesting insights from that. One is, it certainly looks like this captive natural gas that we've got here in the US may not be so captive in the very near future because we have a lot of export capacity coming on. And so what that tells me is that we're gonna, within the next couple of years, we should see this arbitrage close between the price of TTF gas in Europe and the price of Henry Hub here in the US. And those two should converge. Personally, what I'm seeing with energy balances and what's happening with the coal trade and the natural gas trade, it certainly looks to me like there's not enough energy to go around in the world. So I would tend to think that the Henry Hub price is going to move towards kind of where we're seeing with the TTF price right now. And, natural gas could go a lot higher. But the strong view that I have, even stronger than which direction natural gas is going to go, is that you're going to see world pricing and US pricing converge once we have these projects come online, and that you're no longer going to see this huge discount on natural gas in US.
That's exactly my thoughts to the T.
Yeah.
So do you think natural gas over in Europe is going to come slightly down and we're going to come slightly up and we're going to meet somewhere in the middle? Or do you think natural gas in Europe is going to continue to stay elevated and our natural gas is actually going to work higher, or we just don't know?
Yeah, I like to go from the standpoint of I really just don't know, and to make predictions on that it's pretty tough. But it certainly seems like the gas price in Europe is unsustainable. I mean, it's many multiples higher than the oil price, and for me, one of the most bullish data points on oil right now is like you can burn oil for energy or for electricity far cheaper than you can burn gas.
Yep.
And so, there is capacity over there in Europe to switch from gas to oil. And I think that that's going to happen. If I had to guess, the current gas prices in Europe are unsustainable. We're going to see some normalization there. But compared to where those prices are at right now, the Henry Hub price of natural gas is just downright cheap. So, my money would be on the two converging somewhere in the middle. But I am a firm believer in that the solution to high prices is high prices, and the trade has a way of kind of figuring this stuff out. So I'm going to be keeping my eye on energy balances and inventories. Right now, it certainly looks to me like global balances are still treading water at best, and if anything, declining. Despite what's amazing to me is you had all of these people saying, well, the price of coal can't keep going up, the price of gas can't keep going up because China is going to be mining all this coal, and they're going to be bringing in a bunch of new coal from Mongolia, and India is just going to turn on more coal capacity. Well, guess what? All of that happened. China is mining an unprecedented amount of new coal. They're bringing in all of this new coal from Mongolia. India's coal production numbers are up the best that they've been in years. And yet, despite the world's largest coal producers bringing on more coal capacity than they have in years, global energy balances are still super tight. I just don't think that year after year, India and China can continue on this pace of increasing coal capacity like they have over the past year. And so where's that energy going to come from? It's certainly not going to come from new coal mines in the West. You look at the numbers, it doesn't look like it's going to, if anything, in the coming years, we could see peak gas in the US. So I just don't know where all the extra energy, base energy capacity is going to come from. So, I tend to think that the risk is prices to the upside.
Yeah. And you're saying in all energy, like coal, natural gas, oil, just in general, the average of those will continue to go up until we find a solution of some sort.
Yeah, I think that we're going to see some convergence across, just on a dollar per BTU basis across all of those. You look right now, and the price of Newcastle coal and the price of oil on a BTU basis for just energy generation has converged. that price is still far lower than the price of gas in Europe. And so I'm expecting to see the price of oil and coal to converge with the price of European gas, because, other than the carbon costs over in Europe, it's cheaper for them to burn coal or just straight burn oil right now than it is for them to burn gas. And push comes to shove, I think they're going to do that.
Mm-hmm. And how would nuclear fit in this as well? Because on a dollar per BTU basis, nuclear owns all, right? I mean, it's super cheap.
Yeah, it's funny. In the US, we just shut down another nuclear plant recently in the Northeast somewhere. I forget which one. And I was reading an article about it. And when they made this decision to shut this thing down, it was because it was too expensive compared to gas. When gas was at, $2 per thousand BTU, right? Yep. And it was more expensive by like 50%. So it was like pricing if gas is at like $4 per thousand BTU, it's cheaper than gas, right? And now we're at 9.
Yeah,
and
9. Yep.
we're talking about it going higher. At this point, what we know now is nuclear is a no-brainer. And having done business in China for 9 years and watching them put up new factories in seemingly 6 months, I would plan that the response from China on nuclear is going to be fast. Whatever it takes us, however long it takes us in the West to build a nuclear plant, it's going to happen in China in half the time. So, I would plan for China could have major new nuclear capacity online in 3 years. So to a certain extent, you have to temper your expectation for this being some kind of like decade-long bull rally, but we're certainly not making any more new coal mines in the West. So there's that. So you have these structural factors where, we're moving away from any kind of new energy capacity in the West. But on the other side, you have China, which is going to pull out all the stops to bring on new nuclear, new coal, new solar, new wind. They're doing it all. So it's just something that to keep in mind, and we'll have to keep an eye on how fast that they can roll it out, because they will roll it out as fast as they
can. And then I got another question too. I know it's kind of all for me. When viewing commodities and the shipping routes and all this stuff, is there anything that an investor can gain by knowing or by looking at certain data through shipping that we could gain, extra? Like, what could I follow in shipping to get an extra edge to see how perhaps these companies are doing? Like, we could see increased shipping rates of iron ore, or sure. Is there something I'm trying to ask a question that I don't necessarily know the answer to. So what sure. should I be looking at through shipping? Is it just rates? Is it something to do with what? If I'm a commodity bull market bull,
Yeah, it's a great question. Historically, everyone used to look at the Baltic Dry Index, which is dry bulk shipping rate index, for a signal on how the broader economy's health is doing. I think it's a lot less pertinent today than it maybe was 15 years ago, because, especially the US economy is more tech-based, and it's, how much iron ore is moving around the world is not as indicative of how the global economy is doing. But certainly, when you see in general dry bulk and tanker rates going up, it is a signal of health in the global economy, and specifically on the manufacturing side, and is a good indication on what's happening with China. And it will end up being a leading indicator. I personally look at, I watch the steel manufacturing numbers in China very closely. I watch iron ore inventory numbers in China very closely, iron ore prices very closely, because for me, that if there's one kind of leading indicator thing you can look at for the strength of the Chinese economy and what people are thinking is going to happen with the Chinese economy, iron ore is one of the best ones for me. So when you start to see the iron ore price tick up, and you have all these speculators in China that are bidding up the price of iron ore, you know, that could be a tell that that what people in China are seeing, the smart money in China is seeing, is that government's going to come out, it's going to stimulate, and we're going to see an upswing in the Chinese economy.
Okay, and here's, I know this, it may not be related to you. It's a comment that I'll make, and maybe you can make a comment on it.
Sure.
So one of the things that I notice is I always watch the 10-year yield. Yields going up and down. When the 10-year yield goes up, people are dumping bonds. And China, they also may look at bond purchases or bond selling pressure based off of the rate of inflation. So Chinese demand could be linked to the 10-year yield or bond prices. So yields going higher, bond prices going lower. They're dumping their bonds and they're literally buying commodities with it. So what I'm trying to see here is, could I use a metric where I look at the 10-year and bond prices, those start to drop, then I look straight to China to see if iron ore, steel prices are starting to go up, because and dry bulk shipping rates. Because if that's the case, what's happening is the demand is being spurred by the value of the holdings that they hold, and they have to get rid of their dollars. And if they get rid of their dollars, they're saying, I got to get out of here. I need to go buy something that's not going to lose its value. This is a great time to go buy a bunch of commodities. And then we could see it in the shipping rates and all that stuff. Are we seeing right now a stabilization or an increase in those shipping rates of steel, iron ore, and the stuff that you follow?
Yeah,
to China, or whatever you're following.
Yeah, it's hard for me to comment because I'm no expert on the fixed income markets and whatever else. But I will tell you that China it's a managed economy, and honestly, they do a great job with it. And whereas the rest of the world kind of just allows just free market, and you see these big price swings, boom and bust, you will see China intentionally manage the purchasing of commodities to try, and if prices go too high too fast, you will see them come in and take a bunch of steps to reduce the amount of commodities that they're buying and start working off inventories to try and bring world prices down. China is actively trying to manage world prices by stockpiling when prices are lower and working off inventories when prices are higher. And so it's something you definitely need to be watching, as far as when prices of something get too high, as far as commodities go, you're ripe for some headline risk of China coming out and putting higher margin requirements on trading of those commodities and these type of things, because they will actively try and manage that price down. And the same thing can be said with when commodities are kind of on the lower end of the range as far as prices go. You will see the stockpiling in China go up because they're actively managing this stuff for pretty much the whole world. They're the biggest buyer of all these commodities. And, we have them to thank for doing some of the dampening on the high prices and supporting on the low prices.
And do you see them buying right now with the stuff that you're watching?
Yeah. So iron ore inventories started to tick back up probably about a month ago, and have been rising. And that is coincident with the iron ore price falling. So they've stepped back into the market. They're buying more iron ore than they're using. And there's kind of two ways to interpret that. The stockpiles were very low when they started to stockpile again. And the other interpretation is that traders are seeing an upswing in the Chinese economy and steel production in the second half, which would be very good for dry bulk rates, and is kind of has been my base case, and has been the base case of a lot of other kind of people that follow the dry bulk sector closely. Is we're expecting to see China come in and stimulate in the second half and start, the economy start to pick back up out of this COVID zero, slump that we've been in.
Yeah, and is there anything that can totally disrupt this this shipping thesis? Is there something that could just blow this out of the water? Like you're talking like recession, depression. I mean, obviously those seem pretty obvious, but is there anything else that you might be worried about?
So long as you have the right time horizon, if you're looking to buy and hold for a number of years, and when you look back at like the financial crisis, dry bulk volumes, tanker volumes dropped dramatically for 1 year and then rebounded right back to trend, and valuations went right back to trend. So long as your time horizon is long enough, going through any kind of recession or anything else, generally you pop right back up to trend. Now, the one thing that kind of keeps me up at night and is definitely something to consider in the space is if we have some kind of China-Taiwan conflict and we put sanctions on China, China is the buyer of like 50% of seaborne dry bulk commodities, and they're not that big in the global oil trade, but they're probably the biggest player in global oil imports. So sanctions on China would be, I would imagine, especially bad for dry bulk. Maybe less so bad for tankers, because China still still needs oil, and I'm sure it's still going to get its oil, sanctions or no sanctions, especially now that they've got kind of a forced trading partner in Russia. As dry bulk goes, it would be very interesting to see how global alliances shake out if China initiated some kind of conflict with Taiwan and the US stepped in and sanctioned. Their biggest trading partners for dry bulk by volume are going to be Brazil and Australia. I'm going to guess that Australia is not going to participate in a sanctioned trade. Brazil might, but losing Australia's volumes, it would be kind of a death blow. Could be a death blow to dry bulk rates. So definitely something to consider if you really believe that they were going to get some kind of major conflict with China. Dry bulk is not the place to be.
Yeah, and these are all priced in dollars, right? These shipping rates worldwide.
Correct. Yeah.
True. So
yep.
If we had problems with our currency priced in dollars, those rates could go up dramatically as well, right? Is that a true statement?
If we had problems with the
value of the dollar.
The value of the dollar. Correct. So yeah. So as far as inflation goes, if you're looking for an inflation hedge, there's few better places to be than in shipping. I mean, in shipping, a lot of the value is tied up in the steel in the ships. When the cost of energy and the cost of the materials to make the steel goes up, the value of your underlying assets goes up. The value, the rates that they're going to make generally goes up in an inflationary environment. So it's a great inflation hedge.
And here's one last kind of question here. I'm not a shipping expert by any means, and you follow the industry much more so. What questions should a new investor be asking about this industry? Like, what should they be looking for? What if they wanted to get better prepared for investments in shipping? What kind of questions do they need to ask, so to speak, or what kind of questions should they be answering for themselves? Because I look at a sector. I did a lot of my due diligence. I know that the order books are super low. I know that there's going to be a supply demand imbalance over the 2020s, and I know all the kind of the top level stuff. But from your perspective, what kind of questions should they be asking?
Yeah, no, I think one of the questions that has to be asked is this the type of industry where you buy and hold and have it be compounders for decades, or is this kind of the buy it and hold it for a few years type of business? And I would say that it's definitely more of the latter. And so it's not for everybody, but I think it is for the type of audience that you have here, the people that are doing their own due diligence and are interested in watching the industry. And so this is not an industry you get married to. It is prone to booms and busts. And what you really, if there's one thing that you can distill this industry down to as far as looking at the data point that you have to be looking at is the new ship order book. Is when these ship owners rush out and they order, you see those order books go up to 15, 20%. That's kind of your clue to take your profits off the table and kind of wait for the supply side to come back into balance, and try and time the next bottom of the long cycle.
Okay. Is there anything else that you'd like to share? I mean, I'm kind of out of questions here, but anything else that you think the viewers should know? Or
no, but feel free to hit me up on Twitter, at AllThingsVentured. I'm happy to chat, happy to answer questions. I think you'll find some good long threads in there about tankers and dry bulk if you want to read some more. And happy to point you in the direction of the other guys on Twitter, where you can find some really good insights and some free commentary on what's going on with the market. And just really enjoy the sector. Happy to talk about it with anybody. And it's been fun.
All right. Well, thanks for coming on, Nick. I really appreciate it. Lots of good information there for everyone to watch, hopefully multiple times. And we'll catch everyone later. So thanks for watching.
Okay, thanks.